Ladies and gentlemen, good morning. It's our pleasure to have you in this webinar. Very quickly, I will start by introducing our panelists this morning. The economic review will be taken by our CEO, Mr. Alpesh Vanda. The taxation measures, we have two discussants, and that is Mr. James Muridi, our tax director, and Mr. Kevin Chege, our tax manager. For me today, my role is that of MC and to coordinate the discussion this morning. As you can see on the screen, the budget theme was bottom-up economic transformation and climate change mitigation or adaptation for improved livelihood of Kenyans. This is a mixed bag kind of a budget, very interesting times when many Kenyans are going through very difficult times. And for me this morning, I would like to take a few minutes to walk you through the main daily entrance so that you see some of the reactions. And looking at the standard newspaper, the screaming headline is budget pain or reward, right? Very interesting, very interesting. And the business daily, IMF, World Bank fingerprints on Ruto's 3.6 trillion budget. Very interesting, an allegation that the World Bank and IMF have influenced this budget. I think the jury is out there, guys. It is for you to decide. And the Daily Nation and Times. So I encourage you to take your cup of coffee, tea, or water as we get to our panelists to break it down for us. As you've seen from the headlines, there's no doubt that we are in for hard times. At this juncture, I have no option but to yield the floor to the first panelist, Mr. Alpesh Vanda. But before then, I just want to let you know that at the end of this discussion, we'll be answering all your questions. So go to the Q&A tab, post your question there. Please put your name in it, and we will be responding at the end. Alpesh, the floor is yours.
Thank you, Michael, for enlightening us on the headlines for today's newspapers. No wonder the opposition MPs walked out yesterday. Good morning to everybody, and thank you for joining our seminar. I'm going to take you through the economic review. Just the key items which affect Kenya's economy. We'll look at Africa's growth rate. We want to see how Kenya's performance has been on each sector. Our exchange rates have been a big debate for the last couple of months, or I would say a year, 12 months. We also want to look at our fiscal deficit, look at the public sector and expenditure, how it's going to perform. We also want to compare Kenya's economy to East Africa. Big public debt, again, it's a big debate for the last couple of years. We're going to touch base on inflation, interest, and bank rate, which are all interrelated. Another important area that we want to focus on is the pricing of the petroleum products. Africa's growth rate, I think we're all aware, we just came out of COVID in the year 2021. It's been negative in 2020. And the world has opened up for global trade, and it's gone up to about 3 to 4%, and it's about to flatten out going forward. I'm very doubtful whether Africa will be able to achieve the growth that it's intended for or forecasted. I think because of the global turbulence in the financial markets, but time will tell, because Africa is heavily affected with whatever is happening in the Western world. On the East African performance, Kenya has not done so badly despite the turbulent global economy. We've just been hovering between 5 to 6%. It's important to also compare other East African economies like Tanzania and Rwanda. However, take note that these economies are much smaller, so the growth rates are expected to be much higher than Kenya. Kenya's projected rate is about 5.4%. It's going to be interesting to see, despite with the new finance bill and the increase in taxes and what Michael has just mentioned on the papers, it's going to be interesting to see whether we're going to achieve the 5.4% the next financial year. Looking at the sector performance, we all know that Kenya is an agro-based economy. Our economy was heavily affected by the long drought, and the government is now focusing on planting 15 billion trees by 2032. That's an interesting move from the government. So agriculture is a big component, manufacturing is a big component, construction and transport. So I think the key message for everyone is, I think global change, climate change is important for Kenya. I think we need to focus on making sure that we become more green, corporates become more green, to make sure that our planet is much safer going forward, and we have food security globally, and especially for Kenya. We want to just touch base on the US dollar. I think we get lots of questions from clients as well, a lot of discussion on what's happening around the world. I think it's important for us to understand how important and what's the strength of the US dollar globally. 90% of forex transactions are done in US dollars, and all inter-country foreign exchanges are used through the US dollar. And it's important that we understand that any dealings that you do, the US dollar will come into play. You have to go back to the history to understand why the US dollar is strengthening. You have to go to the 1970s due to the global fuel crisis, and appreciate that the dollar, whatever happens in the US, is going to affect everybody globally. 50% of the global trade is done in US dollars again. So if the demand and Kenya being having a current account deficit, the demand for dollar is going to be much higher than what we export. So that's one of the reasons why the dollar has been strengthening. We also have to appreciate that there's high inflation, which we're going to talk about in the Western world, and this has actually strengthened the dollar over time. How the dollar is going to perform in time to come, we do not know, but it's important to know that the Fed's just 2 days ago paused the rate. It's now 5.5%. I think it's still a pause. It all depends how the inflation is going to play out in time to come, third and fourth quarter. If the rates go up further, the US dollar could strengthen. So it's important that for all corporates, for all CEOs, for all directors, it's important to understand what's happening globally on the financial markets, because that has a big impact on Kenya's economy. On the retail price of petroleum products, again, we bring this into picture is because the price of petrol has gone up, the fuel costs have gone up, and it's going to go up further because, as my colleagues will talk about it later, we're going to implement another 8% additional VAT on petroleum products. But the reason why we have to discuss petrol is got a big implication on the cost of living prices. It's a multiplier effect. I think it's also important to bring Saudi Arabia into question as well. Saudi Arabia is now very much focused on the price of oil. We are all aware by the year 2030, 2035, we will only be producing electric vehicles. So they intend to diversify their economy, and they want to have a certain minimum price. Just about a couple of weeks back, Saudi Arabia cut down on production. They just announced a cut down on production, and the price of oil just went up by $9 within a day. So it's important to focus on what's happening with Saudi Arabia, and especially the Middle East countries. I think they all want to diversify. We all know what's happening in Dubai. We know what's happening in Qatar. They just hosted the recent World Cup. There are also talks around the world that Saudi could be vying to host the World Cup in 2030 to 2034 to showcase to the world that we are open for business. So all these issues are going to have a major impact to us going forward. Inflation has been high. We are always maintaining between 5 to 7.5% in Kenya. It goes to almost 9 to 10%. We've been forced to increase interest rates from 7 to 9.5% over the last 14 months. Unlike the Western world, where the rates have increased much higher, main reason being is to counter inflation, is mainly because of the cost of living prices. We had the war in Ukraine and Russia, which started last year in March. And we did appreciate how big these economies are. We did appreciate Ukraine was one of the largest producers of wheat. We did appreciate that Russia was one of the largest exporters of crude oil, steel, ore, and fertilizers, which Africa needs it heavily for agricultural purposes. I think all these issues, with whatever is happening globally, have increased the cost of the price. Interest rates, Kenya, to counter inflation, the CBK governor has been very reluctant to increase the rates at the pace at which the Western world did. His hands were tied up. You have to appreciate as we go along that our debt is 50% in foreign currency, 50% is domestic. So he needs to weigh the balance. Where does he take the hit? Does he take the hit on the foreign exchange side, or does he take the hit on the interest side? So I think he's tried to avoid hiking up the interest as high as he could. And that was one of the reasons why the bonds, when early start of this year, were undersubscribed, especially the long-term bonds. But those of you who are investors, it was good news. Just 2 days back, the bonds were oversubscribed almost 4 times, almost 367%. The interest on the infrastructure bond has gone up almost 16%. If you gross it up, take the withholding tax of 15%, the rate now is 19%. So what the market was saying, we are willing to give money to the government, but we need a good rate on our return, taking into consideration the risk that we are undertaking. But it's going to be interesting to see whether that's going to create a crowding out effect, whether the banks will be willing to lend to the private sector and for the economy to develop. Again, on the interest rates globally, as I mentioned, the rates in the US, if you go back to 2008 during global financial crisis, we had a lot of havoc in the financial markets. The rates went down almost 0%. Lots of economies were into a recession. And they had to really reduce the rates to 0 to make sure the economy can get back to where it should be. Over the last 10 years now, and because of all these crises, the rates have increased. The inflation in the US was double digit. The inflation in the UK has also been in double digit. Whereas the inflation in the US in double digit. To counter that inflation, they've had to increase interest rates tremendously. So the US has increased from almost 0.5% to 5.5%. The EU from 0% to almost 4%, and the UK from 0.1% to almost 4.75%. So if they've increased the rates to almost 4% in developed nations, there was no reason why our government actually reduced our rates by only 2.5%. And that's one of the major reasons why our exchange rate has actually depreciated. We need to take that into account. Exchange rates, this is a big talking point. Again, as I mentioned, it's all related to do with inflation and the high interest rates in the developed world. I've been told the rate today is almost about 143. The pound is touching base almost very close to 180. Again, as I mentioned, we import more than we export. So again, I don't know how we're going to deal with the cost of living prices. It's important for manufacturers to appreciate. I think there has to be some kind of a cutoff because we need to understand whether we're going to be able to pass on the additional costs to consumers when the disposable income is going to reduce based on this new finance bill 2023. Public sector and expenditure, we are always in a fiscal deficit for the last couple of years. Deficit is about between 600 to 700 billion. Last year, our budget for this year is expected to be about 3.7. We expected to collect about between 2.9 to 3 billion. So that's another deficit of about 700 billion. It's important to note that our president has been very conscious of this. He wants to reduce the fiscal deficit from about 4% to 3.5% in the medium term. I think this is more to do with the debt levels. I think we also need to appreciate there are about 22 countries in Africa are in debt distress. So, when we look at the negative headlines in the media, I think we need to take it with a pinch of salt. We need to appreciate and understand how is Kenya's economy performing to other economies. So it's not only Kenya which has debt distress, it's all other economies. Kenya's debt is expected to hit 10 trillion by June 2024. As I said, 50% is in foreign currency, 50% is in domestic currency. I think it's important to appreciate also is that if our currency depreciates by 10%, right? Straight away there's an exchange loss of 500 billion shillings, right? So that has been a big challenge for the government, especially for the cabinet secretary, and that's why the IMF, the World Bank, they're trying to assist. We've received almost $1 billion. There's some more funding supposed to be coming in the month of June, July. and our debt is expected to increase as well. And they've also changed the ceiling, the way they measure the debt. Before we used to have a debt angle of 50%, then we went to a ceiling of 9 trillion, then we increased the ceiling from 9 trillion to 10 trillion. And now they're going to go back to a debt anchor, and they're going to try to stabilize the debt levels at 55%. I think all these measures are coming from IMF, the World Bank. I think we don't want Kenya to go through what Sri Lanka is going through, or what Gambia is going through, or what Zambia is going through. I think it's important that we rather go, we rather love through the tough times, right? And we find the right measures, get efficiency. We need to tighten our belts, because when you look at also other countries, even developed nations like the US, where the debt level is almost $32 trillion, and it's expected that in the next 10 to 15 years, that will be about 50 trillion. The GDP to debt ratio in the UK is almost 100%. Likewise in Portugal, likewise in Spain, Greece, Argentina has gone through a crisis as well. So there are lots of countries around the world who have a debt issue. And as I mentioned earlier, 22 countries in Africa are also going through the same. In Nigeria, they have removed the subsidies to handle the debt issue, and the price of petroleum has tripled, right? So we need to take concern of that it's not only Kenya who's going to suffer. We need to ride out the tough times, as I mentioned, and we see how this bill is going to play through. According to me, I think the next 18 to 24 months is going to be extremely difficult for the country. And mainly because we need to focus on what's going to happen in the Western world, how fast the inflation is going to come down. Based on those numbers, interest rates will come down in time to come. But I think the next 18 to 24 months are going to be very critical for us. I will now pass over to our tax director, James Muliki, to take us through the taxation proposal. Thank you.
Thank you, Alpesh, and good morning to everyone. We are going to look at some of the tax proposals that are contained in the Finance Bill 2023. And we actually choose to look at these in a progressive manner and build up to the previous webinar we had when the Finance Bill 2023 was published. And if we were to go by what Mike has just shown, the kind of headlines that are there in the dailies, this is actually what each and every person should expect to see once the Finance Bill 2023 is out. I would say the Finance Bill 2023 is still work in progress. What we will take you through is not the final position. I believe we'll have to wait for the Finance Bill 2023 to go through the third hearing before the President affirms the bill into an act. Now, what we have done is you will discover that the bulk of the content in our slides is primarily what we had in our presentation on the Finance Bill 2023. But then there are certain variations based on obviously the budget statement that was presented by the CS yesterday, as well as the report from the Finance and Planning Committee of the National Assembly on certain variations here and there after the public participation. So the very first item we're going to look at are tax procedures. And as I've indicated, you'll notice that the bulk of what we have in the slides is what is in the Finance Bill. However, as we move along, you will notice that there are sections that are in orange. And basically, those are the sections where there's a bit of variation based on the report by the Finance and Planning Committee, as well as the budget statement. But we will also be touching on some of the critical areas of interest, which have not been varied to a large extent, and which we believe by the time we get the Finance Act 2023 might still be in place. And on the very first two bullet points, is something that the CS also alluded to yesterday in terms of waivers of penalties and interest on unpaid taxes. number one, I think he was categorical that going forward, there will no longer be waivers of penalties and interest. So what that basically means to all of us is that there is need to ensure compliance, because in the event of an assessment and these taxes are demanded, the option that every taxpayer is out there of making a waiver application, that one will be gone. So that one is going forward. However, there are two aspects of waivers of penalties and interest that we're going to touch on. And the first one is, there are those waiver applications that had already been lodged, and the principal taxes had already been settled by the 31st of December 2022. Now, the proposals in the finance bill as they are suggest that if any principal tax had been paid by 31st December 2022, then those penalties and interest sort of are automatically waived. However, I would like to highlight something that has been happening over the past 2 months or so, where the KRA has actually been reaching out to taxpayers with regards to previously lodged waiver of penalty and interest applications. And I believe a majority of the participants must have received communication from KRA, basically where they put a proposal on the table to waive 40% of the penalties and interest, and for taxpayers to pay the balance of the 60%. Now, from our interactions with KRA, they sort of suggested, without being committal, that they had received a memo from Treasury empowering them to actually put this proposal on the table and to have a discussion with taxpayers who are affected to take this up. And the question that actually we asked was, are these proposals enforceable? Can KRA demand? Because you find that on the proposal for settlement of the 60% of waiver of penalties and interest, KRA are actually saying that these amounts have to be paid by 30th of June 2023. But then we view this as an exercise for them to quickly mop up these previously lodged waiver applications before the change in the law. Now, what about any tax liabilities that were unpaid as of 31st December 2022? There's actually a proposal sort of for an amnesty in full of the accrued penalties and interest, provided that the taxpayers are able to settle the principal taxes by 30th of June 2024. And I think when the CS was reading his speech yesterday, he said that this will run from 1st of September 2023 up to 30th of June 2024. So I think this is a welcome move to just clean up affairs to make sure that there's no exposure when it comes to any accrued penalties and interest for any principal taxes that have not been paid as of or that were not paid as of 31st of December 2022. Then quickly, the issue of the commissioner having powers to abandon taxes where it is difficult for this tax to be collected. I think the proposal is basically to do away with this power. On the timelines for resolution of tax disputes, assuming matters are proceeded to the tax appeals tribunal, there's actually the option to pursue the alternative dispute resolution, and those deliberations are normally should happen within 90 days. But then you find that this process is quite involving because sort of it's a tripartite discussion. There is the taxpayer, there's the commissioner's assessing team, and there's the ADR team. So the deliberations take a lot of time, especially for the ADR to appreciate the merits of the appeal. But also more importantly, you find that some of the disputes that are being litigated are very technical and complex and require a lot of time. So the proposal to extend this time from 90 days to 120 days under ADR deliberations still seems to be in place. So we shall wait to see when the Finance Act comes out if these timelines are maintained. Then if I was to quickly move through to the second last bullet, you will notice that there are provisions as we speak currently on a tax shortfall penalty of 75%, where there is a deliberate non-payment of tax or a deliberate non-disclosure or misstatement of tax disclosures, which is quite a hefty penalty. Because if you compare ordinarily, you'll notice that once you are assessed, the penalties for the different tax obligations is normally at 5%. Then there's a 1% monthly interest on the unpaid tax. So what basically the report that the Finance and Planning Committee is proposing is to retain the penalty at 75% as opposed to double of the tax that was due. I will move on to the next slide. Now, in this slide on electronic tax invoices, based on the report as well as the budget statement by the CS, there seems to be no change. And basically the emphasis here is e-Teams compliance. There are obviously those challenges that are in terms of the practicality of all businesses, whether big, small, or medium, to make sure that there is compliance. And if I can speak on to this issue, in as much as it will enhance VAT compliance, the other issue is the proposals from an income tax point of view, where no expense will be tax deductible if the invoice is not generated from e-Teams. So you can actually see, in as much as they're saying their budget deficits, this approach that is being adopted is an approach that goes towards addressing the never-ending discussion we have of expansion of the tax net to ensure that there is proper tax disclosure. So I believe that each one of us should be on the lookout, make sure that the systems are in place. There is always a question that comes, what will be the interaction of e-Teams with the electronic tax registers and the Teams rollout? Those are some of the finer details that we are expecting KRA to give clarity, because in as much as they say e-Teams will be a resource that will be available to all at no cost, then it is only logical to understand how the e-Teams system will be integrated to accounting systems and the enterprise resource system, because then at the end of the day, every business, every taxpayer must have some form of control as to how the invoices are generated in the accounting systems. Now, if we move on to other tax procedures changes, I will not dwell so much on the other points apart from the first one, and this is the issue of timelines. Without preempting income tax changes on withholding tax and when it should be remitted, from a withholding VAT point of view, the finance bill had, or rather proposes that any VAT withholding tax should be remitted within 3 days. Now, the proposal in the Finance and Planning Committee report proposes just to move this a bit to 5 working days. And the question here really is, remember the timelines for withholding tax, for withholding VAT remittance is by the 20th of the subsequent month. So legally, they are trying to change that provision for the timeline to make it to 5 working days. Now, in as much as businesses have until the 20th of the subsequent month to remit withholding tax and withholding VAT, it does not mean that the payment must be made on the last day. The 20 days is basically just to give a buffer. And the issue here that will arise, number one, is an administrative issue, because every now and then, businesses have to make sure within 5 days of deducting withholding tax or withholding VAT that these amounts are remitted. Then there's obviously the cash flow issue. We believe that the 20 days give businesses ample time to organize their cash flows and make sure that the money is available for payment. But then this shortening to 5 working days basically means that businesses must have the ample cash flow to make sure that the remittance happens in time. Obviously, failure to remit on time goes back to the issue of basically the accrual of penalties and interests on late payments. I will now move to VAT proposals, and I believe these discussions on introduction or the increase of VAT on petroleum products has been the main issue. And because of the obvious reason that petroleum products are critical to all the key sectors, whether it's transportation, whether it's manufacturing, on basically the price of basic commodities, up and including agricultural produce, because remember, agricultural produce still has to be transported from the farms to the market. Now, so the issue of VAT on LPG. Currently, LPG has a VAT rate of 8%. The proposal in the finance bill was to exempt LPG from VAT with additional incentives relating to LPG with regards to exemption on IDF and RBL, basically to just cushion the increase in prices for LPG. I think since got to the committee, the finance and planning, and to even make it cheaper to all Kenyans, is that they are proposing, instead of exempting it from VAT, to actually zero rate it. Then there is the issue of government's promotion of the agricultural sector, and we have fertilizers and agricultural pest control products, including their inputs, the inputs and raw materials that are used to manufacture these two items. Currently, they are zero rated for VAT, and the proposal in the finance bill was to exempt them. And any discussion about VAT exemptions automatically raises the question, will exemption really lower the price? Because remember, for any person who deals with VAT exempt supplies, the issue of claiming input VAT is not applicable, and hence the input VAT has to be loaded on the price of the commodity. So it's always a discussion of that trade-off of really, does an exemption make products cheaper? Then I think that's primarily the main points there. The issue of VAT being applicable on insurance claims still remains. A lot of businesses are restructuring, and the issue of transfer of businesses as going concern. These are live examples, and the current VAT status of transfer of businesses as a going concern is subject to VAT at 16%. The proposal to exempt this transaction still persists, but there's been a little bit of contradiction, because just yesterday the chairman to the Finance and Planning Committee made a statement that they are proposing to maintain the 16% on transfer of businesses as going concern, because it will net around 100 billion. And we believe this is primarily being informed by the anticipated huge transaction by Safaricom of separating the M-Pesa business to a different entity. So I think they're looking at that one major anticipated transaction, and based on the valuation of basically the entire M-Pesa business, they can actually see an easy win in terms of just trying to meet the 281 billion expected from these tax proposals. I think that is the main point we wanted to drive on this slide with regards to the VAT changes. If we move to excise duty proposals, you will notice that the very first bullet is actually a welcome move for basically to do away with the inflation adjustments on the excise duty rates, which was a difficult thing for businesses, because you cannot have the excise duty rates, the specific rates in particular, being adjusted almost twice a year. You can imagine the uncertainty that businesses were facing when it comes to trying to estimate the cost that they would have to incur. And obviously that has an impact on the pricing. It has an impact on the uptake of products, and this directly affects businesses. On the issue of penalties on excise tax, there are certain there are certain offenses relating to excise stamps. So basically, the committee is proposing to just enhance the penalties around those, just to ensure compliance. Then the issue of remittance of excise duty. What is clear based on the finance bill as well as the report of the Finance and Planning Committee is that for the companies or businesses in the betting and gaming industry, that has to be done within 24 hours. And the reason they're emphasizing on this is because the system was already piloted for these betting companies. It is already working. And I believe 2 days ago, almost 84 additional betting companies have already been onboarded into the platform. And then you can imagine excise duty on betting. Remember, the money is held by the betting companies. So they actually have the funds to begin with to make sure that there is remittance. But then the funny thing is that the proposal for the commissioner to extend this 24-hour excise duty remittance, basically the powers for the commissioner to apply this to any other sector is there. How this is feasible, we are wondering, because this system has only been piloted for betting companies. And if you look at the other sectors, their products are quite diverse. It will actually be very difficult to make sure that the excise duty is remitted within 24 hours, because excise duty then would only be charged once the excisable goods are actually sold to the end users. Then on the issue of excise duty on items containing cocoa, these are largely confectionaries and chocolates. The proposal was to introduce excise duty on all items, whether imported or locally manufactured. And you'll notice that the imposition of such excise duties and import duties on all products, whether locally manufactured or imported, normally hurts the local industries. And I think we have a couple of players in Kenya who do the manufacturing of local confectionery and chocolates. So at least this is good for them, because then the Finance and Planning Committee has proposed that this should only be restricted to imported articles or items that contain cocoa, which is largely chocolates. Then on the issue of imported fish, powdered juice, a very welcome thing to the ladies. There was that worry that all these cosmetic products and beauty products are going to go up. So basically, the Finance and Planning Committee is proposing to exclude local sugar from the proposed 5 shillings per kg of excise duty, and also to exclude human hair, wigs, artificial nails, and pasta from excise duty. Then, and basically, yeah, for the imported fish, they're proposing to reduce the excise duty as is in the bill from 20% to 10%, obviously to make sure that the local needs are met in terms of when it comes to the consumption of fish. Then if we move along to the next slide, like is always the case, I think betting and gaming is always affected each budget cycle. The initial proposal was to increase excise duty from 7.5% to 20%. I believe there must have been some lobbying because of the excessiveness of what this would mean in terms of any gains to the punters. So the proposal by the committee is basically, instead of putting it at 20%, reduce excise duty on betting and gaming to 12.5%. Then there is also a proposal by the committee to reduce excise duty on money transfer by banks from 20% to 12%. If you look at the CS budget statement, he talked of 15%. So, and what we can say at the time, that's why I started by saying, we are looking at a progression of a bill that is still under discussion. We anticipate in the course of next week, when it undergoes the third reading, that possibly there will be even more changes or more variations to some of these proposals that we're discussing. And I think we will only have a final position on all these discussions we are having once it is enacted and assembled by the president. Then on the issue of excise duty on mobile money transfers, basically it was proposed to move it to 12%, but the CS in his budget statement has proposed to bring it down to 10%. And obviously this is informed by the fact that a lot of money transfer is happening through mobile money platforms, through the mobile operator, and it's only fair. It's only fair that the excise duty rates or any taxes applicable on such transfers at a minimum, because then the velocity of those transactions is quite high. If we move on, basically the Finance and Planning Committee is also proposing to exempt from excise duty any supplies that are made for the manufacturing of electric powered vehicles. I think that's where the one is moving, moving away from the petroleum products to electric vehicles. So I think that is an aim just to promote, and it must obviously have been informed by, I remember when Michael talked about the budget theme, one of the things was on climate change, and I think there's a lot of concerted effort globally and even by the IMF and World Bank to make sure that there are measures that are geared towards basically climate change. Then I believe I've mentioned on the issue of excise duty on local and imported white chocolate. So the emphasis basically by the committee was that this should only be restricted to those white chocolates that are imported, and this is basically to protect the local industries. Now, on customs proposals, the reason this never featured or is not in the finance bill and was not also in our last presentation is because any customs changes are not contained in finance bills. And this is because customs matters are legislated under the East African Community Customs Management Act. But as is always the tradition, the proposals on customs changes will always be mentioned in the budget statement by the CS on the budget day. And this is only a highlight of what we expect to see once the East African Community Gazette notice is published by the 30th of June 2023. And the reason is because you will notice that the EAC is one customs territory, and all matters have to be discussed. And he alluded to the fact that all these proposals were discussed in Arusha sometime in May. And what normally happens, in order to rationalize and make it fair for all the member states, you find that there are particular items that a particular member state might want to safeguard. And a good example, when the CS was making his budget speech, he started with rice and wheat, and he talked about the need for Kenya to still import in order to meet the local needs. And you see the current import duty rate on rice, for example, is 75%. And this is basically to discourage the importation of these products and to be able to promote local production of rice and wheat. Now, as we move along these changes, you will notice that where we have the item with the description, there are items that have one asterisk, and there are items that we put two asterisks. And as we move down, the items that you will see have three asterisks. And the reason for that, and towards in the next slide, you'll be able to see what the asterisks mean. You will notice that for some of the items, the current and the proposed duty rates are the same. And the reason for this you find is that there are two main things that normally happen for customs. You will find that one member state might request for an extension either of a duty remission or an extension of the applicable rate to be able to cushion the local industry. And that is actually the general motivation of the things or the items that the CS was talking about yesterday. If you look at rice and wheat, If you look at raw materials for manufacture of parts used in the assembly of motor vehicles, if you look at this issue of the completely knocked down units for the assembly of motorcycles, if you look at those in the iron and allied industry, vegetable products, there was a touch on that the local production of vegetables seems to be sufficient. And in order to protect that, there is an extension of 35% for a further year. And basically, that's what we are speaking to. This is only a highlight, if I may mention. Once the East African Gazette notice is out, you will notice that there will be a lot of many changes that touch on various issues and various items from a customs point of view. I think the CS mentioned something on basically the imports or relating to inputs and raw materials for the manufacture of baby diapers. And he actually mentioned that there was a lot of uptake by local manufacturers. So you can actually see the maintenance of 35% of such imports is just to make sure that at least for the next 1 year, that incentive still exists, because then we anticipate that after the 1 year, most probably the import duty rate might go up. I think the leather and footwear products is a critical area. It was shocking the other day to see some tweets that butter shoe company was closing up. And you see, it's not in Kenya's interest for butter shoe to close, because this is one of the companies that is really promoting leather and footwear products. So you can actually see for that as well. There's that maintenance of 13%, and it's basically just to make sure that it protects the local industries. On the issue of roofing tiles, similar proposal, basically 0% duty on imports. So there's actually a request to maintain that for 1 year. For those who deal with paper and paper products, there's a proposed increase in the duty. Safety matches, I think those who deal with furniture, you can actually see what the proposed changes in duty. But just to emphasize, and I repeat, we shall only know the full picture of this proposal that relates to customs when the East African Gazette notice is out. Now, at the bottom of the slide where we put a note, you'll notice anything with one asterisk is where Kenya has actually requested for an extension of the previous year's custom duty rate to be applicable for 1 year. Then 2 asterisks is basically anything that was enjoying a duty remission. Kenya has basically requested for that to be extended for a certain duration of time. Then on the 3 bullets is basically the issue of the ad valorem rates of a duty that range between 120 USD to 200 USD per metric ton. So in a nutshell, that gives you an overview of what to expect from a customs duties point of view, but we shall obviously, in our last once the Gazette notice is out, we shall basically highlight for you some of the critical items that would be of interest. That brings me to the end of the first set of proposals, and I'll hand over to my colleague, Kevin Chege, to take us through the remaining tax proposals and the miscellaneous proposals.
Thank you very much, James, for a very elaborate discussion. And I'll take it over from where you've stopped, but just give a small snippet of what has transpired since the last time we had this webinar. So the last time we had this webinar, we had the finance bill that had been issued to the public for public participation. And as a PKF, as well as other stakeholders, presented our views, as well as those of our clients, to the Committee of Finance and National Planning on issues we felt that they ought to relook, on issues we felt that some changes needed to be made to enable or to enable businesses not to experience any challenges in their operations. After that, the Committee of the Finance and National Planning tabled their report on Parliament, I think around earlier this week. And subsequent to that, they have been voting on the finance bill through the second reading. I'm sure many of us have been following her on that because of the many interest areas that are touching on each one of us. And yesterday there was the budget reading by the CS, and subsequent to that, next week we will have a third reading where each of the proposals in the finance bill will be voted on, and after that there will be the assent by the president into law. The reason why I'm giving that snippet is because you'll find that there are things that while they are in the bill, the Committee of Finance and National Planning has proposed some changes. There are items they are not, or they have deliberately decided not to take into consideration the changes that were proposed by the stakeholders. And there are some few new recommendations from the Finance and National Planning Committee. We'll only know the fate of all these proposals once the bill is subjected to a vote and it's attended into law by the president. Quickly going through the changes through the Income Tax Act, I'll just highlight what has been through a change, as some of these issues will still sustain through the bill and maybe towards the end to the act. Now, the issue of interest restriction and deferment of foreign exchange losses. It has been a thorn in so many businesses that people are forced to restrict interest even relating to locally procured loans and even on including also the foreign procured loans. The finance bill tried to cure that anomaly by providing that only loans related to foreign or entities or loans procured from foreign entities will be subject to the interest restriction provision. There was an ambiguity of which so many stakeholders raised that the 3-year period that was provided to claim any deferred interest or any deferred FX losses was not mainly enough for businesses to recover from a position where they are within the 30% EBITDA. Through the recommendations of the stakeholders, the CS and the Committee of Finance and National Planning have proposed to increase that period from 3 years to 5 years. In terms of digital asset tax, this one the government wants to introduce it in a bid to bring into the tax bracket any transactions that are carried out relating to digital tokens or mainly of the cryptocurrencies. There was a lot of hue and cry that we cannot tax the fair market value of those transactions. And from our discussions and from the Committee of the Finance and National Planning, that seems to be sustained. The only change that has come or has been proposed relates to the timeline of the remittance of that tax, where initially it was supposed to be within 24 hours, but the Committee of Finance and National Planning proposes that that remittance will be done within 5 days or 5 working days. The issue of turnover tax has been a hot debate, I would say, because the introduction of turnover tax was meant to ensure that the informal sector are brought into the tax bracket. We've always talked about tax-based expansion and ensuring that the informal sector and the agricultural sector is brought into the tax bracket. How this was meant to work was that any person that currently has a turnover of between 1 million and 50 million shillings, you apply the simplified approach of the turnover tax and you pay a tax at the rate of 1% of your turnover. There is really no requirement to maintain books and so forth. So I don't know how the uptake of that has been, but there was a return. Previously it was at the rate of 3% through the COVID stimulus programs. This was proposed or was changed to 1%. Now, the Finance Bill 2023 had proposed to more or less reduce that bracket to 500,000 shillings to 15 million shillings turnover in a year. But through the many stakeholder recommendations, the CS and the Committee of Finance and National Planning have proposed to have that bracket between Kenya shillings 1 million and 25 million in a year, but they have sustained the rate at 3%, which was the rate before COVID. We will wait to see how the uptake of the turnover tax will be, because there is a huge potential in bringing the informal sector into the tax bracket. Issue to do with withholding taxes. There was the expansion of the withholding tax bracket to cover sales and promotion and marketing services, as well as people who are doing digital content creation. I think the guys in the digital content creation were able to lobby enough even through the president during one of the forums, and there was a commitment to reduce that rate from a high rate of 15% to a manageable rate of 5%, which is in line with other professional services. The issue of timeline, the finance bill proposed that these withholding taxes would be limited within 24 hours, but upon recommendation by various stakeholders, the committee has eased that up to 5 working days, which, as James alluded to, will also create some distortions in terms of working capital for businesses. In terms of other income tax changes, I think most of these have been maintained through the finance bill, as well as the recommendations by the Committee of Finance and National Planning. Some of those changes that stakeholders had proposed have not been taken into consideration, but just to note a few of them is that with relation to the introduction of a branch repatriation tax, remember the finance bill proposes to reduce the tax rate for branches and other permanent establishments from 37.5% to 30% to harmonize with other business forms in the country. But also, in line with that, there was also the introduction of a branch repatriation tax on any incomes repatriated by the branch to the head office. However, the bill did not have a rate, and the Committee of the Finance and National Planning has proposed a rate of 15%, which is also the rate that companies are subject to when distributing dividends to non-resident entities. In terms of CGT, there was a proposal to provide for the timeline of the payment of CGT, but through various stakeholder participation, the committee has proposed to maintain the current timeline for submission of CGT as it is. In terms of capital allowances, the changes, most of them, the recommendations are that they will sail through. The only change was a change that wanted to restrict investment deduction to investments made of 100%, sorry, to investments made outside Nairobi and Mombasa counties by virtue of those businesses being outside, or they have to be located outside Nairobi and Mombasa. However, through various stakeholder participation, the Committee of the Finance and National Planning has proposed to remove that restriction. We are waiting to see the Finance Act because it will provide much more clarity, because how the wording of the report states is that any business that is within or outside Nairobi, Mombasa, and or Nairobi and Mombasa counties that have a cumulative investment of 2 billion will qualify for 100% investment deduction. But like James earlier mentioned, the final details of how these proposals will come into be will be known once the Finance Act is enacted into law. There has been an issue on the introduction of a super tax fund of 35% on any income above 500,000 shillings. And so many stakeholders were against this for the sole reason that this affects the middle class in the economy, who are the main drivers of what we call a consumption-driven economy. Things to do with entertainment, things to do with healthcare, social protection. So I think this is one of the proposals that more or less fell on the deaf ears of the parliamentary committee. And instead of even removing the rate, they have augmented it further and separated it to provide a 32.5% rate for income between, or monthly income between 500,000 shillings to 800,000, and any income above 800,000 shillings in a month will be subject to 35% PAYE bracket. And the contention about this has been, if you're operating as an individual and you're operating a consultancy, vis-a-vis a person who is employed on a full-time basis as an employee, there will be a lot of distortion, which may lead to tax planning, because the individual who is employed will be subjected to 32.5% and 35% of any income above 500,000 and above 800,000 respectively. However, the person working as a consultant will only pay tax at the rate of 30%, taking into consideration that they will also deduct any expenses that they have incurred in their businesses. So there needs to be some consideration on that, because the government should not be putting in place tax measures that would encourage tax planning around it. So many of the other changes that have been proposed will sail through if enacted as they are. This includes items to do with the mileage claims that will be harmonized with the AA rates. Very punitive proposal that any public officers will not account for or be taxed on their RDMs. I think this was meant to incentivize the MPs to maybe pass some of the proposals that may also touch on them. The proposals on the country by country reporting requirements will also likely sail through, but it is important to note or to mention that the income tax return, or the IT2C as we always know it, has been amended in the section B1 to include additional disclosures for persons who have transactions with related non-resident entities. And this, how we are reading it, is to ensure that there is complete visibility and disclosure in terms of any related party transactions, and ensure that those transactions are being carried at above both prices, or what we call arm's length considerations. I think for those of us who have not filed their income tax returns for the various organizations, you need to take keen consideration on that section B1. And in case you need further guidance on the same, we are always available to assist you on that. Some other few income tax changes. Most of them will say through the items to do with the incremental advanced tax rates. I know there's been a lot of social media debate around this, that each one of us will pay taxes on their private cars, but maybe just to clarify that advanced tax is subject to companies and is subject to the commercial vehicles that entities have. And it is an advanced tax, as the name suggests, which is offset against the income tax payable at the end of the year. So it is not subject to individuals on their personal cars and so forth. So that proposal will sail through. There was a proposal to widen the definition of winnings, which is subject to gaining withholding tax. And this proposal was quite punitive, because it wanted to put into the ambit of withholding tax even the amount that has been staked or wagered by the player of the punter. So there was a lot of hoping and recommendation by various stakeholders around this, because as much as betting, the government says that it is a vice in the society, the government is also collecting a lot of taxes around that sector. And you can see even in the area presentation, they have gone to the extent of ensuring that tax collections from this sector are done on an instant basis or within 24 hours because of the linkage between the betting system and the KRS system. So in line with that, I don't think this is a sector the government would also want to kill completely. And that proposal maybe would have seen or would have sent that industry to the deathbed. But the Committee of Finance and National Planning has considered various stakeholder recommendations and have proposed to exclude from the ambit of withholding tax any amount staked or wagered. So what will be subject to withholding tax will be the differential between what you have won and what you put in as a stake or you wagered. The proposals to add the local assembly of motor vehicles will also sustain, as well as the requirements that for petroleum companies to disclose any transactions where there is a change in the underlying ownership of more than 20% will likely prevail through into the Finance Act. So those are the changes through the income tax, and the final details of it, as usual, will be through the Finance Act 2023, and we will be there and available to give you a deeper analysis of the same and the impact into businesses. There was one proposal through the Tax Appeals Tribunal Act, which brought a lot of controversy or debates in the industry because it attempted to create an unlevel playing ground for players or taxpayers and the KRA. The proposal required that before you do an appeal to the High Court on any decisions that have been issued by the Tax Appeals Tribunal, taxpayers ought to have paid a 20% deposit of the amount of tax in dispute with the KRA. The modalities of how that amount was supposed to be administered and how that refund was supposed to be made once you win the case has been subject to a lot of discussion, and it's still a gray area. But very many stakeholders, I would say very many, if you look at the Committee of Finance and National Planning, this one almost every stakeholder was against, and they seem to have listened to this, and the proposal by the committee is that this proposal will be dropped and will not see the light of day. The other proposals relating to definition of what an applicable decision is to also include any refund decisions to be applicable decisions which likely sustain, and the submission of additional documents to do an appeal at the High Court or the Court of Appeal. I think there was a proposal that would limit that submission of the right of taxpayer to seek leave from the tribunal, from the High Court or the tribunal to add additional documents. I think the committee has considered that, and that is likely to prevail. I think I'll call this the elephant in the room. Reason being, we were having a discussion yesterday where one of the panelists mentioned that the Finance Bill 2023 has been reduced to a housing bill. The discussion dwelled around the housing contribution more than all other discussions around the other 83 clauses in the Finance Bill. The Finance Bill 2023 had 84 clauses, but this one seems to have carried the day in terms of the discussions and the emotions that it elicited in the country. And the main reason is this one seems to cut across so many, all the employed individuals, the employers, as well as the historical issues that we have known around the issue of management of public funds. The Finance Bill had proposed a 3% mandatory contribution to a housing or a national housing fund. And this was supposed to be made by the employee, and the employer was supposed to add another or to top up with an equal amount of 3%, but there was a capping at 5,000 shillings. And from the debate from the national government to the parliament and so forth, the discussion has been around setting up a national housing fund that will be used to build affordable houses. There are a lot of nitty-gritties that were not being put there in the public domain in terms of the administration of this. And if you look at the report by the Committee of Finance and National Planning, you'll find that they also acknowledge that this proposal received the most recommendation, and they even alluded to the fact that only 2 stakeholders out of all those stakeholders, I think the committee mentioned about 1,080 submissions being made, only 2 were in support of this, and the rest were all against this provision. So, based on the CS Treasury budget statement yesterday, as well as the committee report, there have been changes to this provision, and the changes are like this. The rate has been reduced from 3% to 1.5%. And if you look at the wording of it, it's very, very categorical that it is a national housing levy. So it changes from a fund or a contribution to a fund to a levy. And how we know levies is that I think the question that has come is it a contribution, is it a tax? I think this one answers to it that by it being a levy, now it changes to a tax, meaning that you'll not be able to recoup any amount from it. There are some silent issues, like issues to do with the capping, that we expect that the Finance Act will provide the final details to it. I don't know if this is a welcome move to taxpayers and employers, but the duty is out there to decide. There are some other changes through the Miscellaneous Fees and Levies Act, which were proposed through the Finance Bill 2023. We've not seen any changes to this. I think the most pertinent ones was to harmonize or rationalize the IDF rate at a uniform rate of 2.5%, and the IDF rate had been harmonized at a uniform rate of 1.5%. So the preferential rates that were being provided are meant to be scrapped. And there was the issue of the export and import and investments promotion levy, which based on the CS Treasury, this one is meant to cushion the local producers and manufacturers from importation of items that can be produced locally. So I think the discussion around this, despite a lot of stakeholder engagement, is that this is meant to be sustained at the rate of 10%. Moving on, there are some other miscellaneous changes through the various statutory bodies or state departments and ministries that are meant, if you look at it in a bigger perspective, are meant mainly to cushion the informal sector. There were some changes also around transparency, items to do with the Kenya Roads Code, the Statutory Instruments Act. I think these ones will maintain as they were in the bill. The other changes that when you are having an evaluation about them are mostly targeted at the micro and small and medium enterprises, and this mainly goes also to the informal sector. There are some changes to the Kenya Depository Insurance Corporation, which are meant to uplift the current threshold of what is covered under the Kenya Deposit Insurance Corporation from the current amount of 500,000 shillings. So basically how this works is that if a bank goes under and it has your deposits, the Kenya Deposit Insurance Corporation covers you to an extent of 500,000 shillings. So there is discussion to uplift this amount, maybe to ensure that all persons who have deposits in any bank in the likely event that it goes down are covered. There is also proposal to establish an ADR or an alternative dispute resolution mechanism to aiding dispute resolution between members who are subscribed to the Kenya Deposit Insurance Corporation. In terms of capital markets authority, there are some efforts to ensure that the medium and small enterprises have access to the Nairobi Stock Exchange to be able maybe to raise capital in form of debt or shares or floating of shares. So some of these changes include the capital markets, public offers and dispute and disclosure regulations 2023, which have already been tabled, and will enable medium and small enterprises to be able to raise money in the Nairobi Stock Exchange. Some banking reforms. There has been a lot of scrutiny on what we call digital credit providers, those who are providing credit over the mobile phone. So there is some regulations that were issued in 2022, and the central bank is in a drive to ensure that all digital credit providers are brought under the ambit of those regulations. There is also some effort by the CBK to ensure that small and medium enterprises are able to access any payment platforms that are there in the country. So this will include a comprehensive review of the National Payment Systems Act and an implementation of the interoperability payments platform. And this will open up the industry to both the public, the private sector, and also the diaspora to this to be able to take part in the sector. Some pension reforms. There is the introduction of the Kenya National Entrepreneurs Saving Trust, which is mainly based on the CS speech, is meant to encourage savings by the informal sector into a pension fund. Some few changes through the Insurance Act and the introduction of the micro insurance regulation, which, like we said, are meant to bring the informal sector and the micro and small enterprises into the insurance. They are able to take insurance covers easily and uncovered. Some few changes also through the SACCOs societies regulations or through the what you call the SASRA, and there is a proposal to introduce a scrutiny into the shared services platform by the SACCOs, just to bring a lot of transparency in how these SACCOs are operated. And there will also be an appointment of trustees to the deposit guarantee fund, which is aimed at ensuring that disputes are resolved amicably. For the EPZ and SEZ entities, the CS mentioned that any purchases of raw materials or inputs from the domestic markets or the customs territory would also be exempt from customs duties. And in terms of the Betting and Gaming and Notaries Act, the CS mentioned that the Tax Procedures Act will take effect in the administration of any taxes that are incurred by the Betting, Gaming and Notaries Act. Maybe just to mention about the last one is that the CS mentioned that there are some regulations that which are meant to come into law very soon, and these regulations are meant to uplift the contributions to the National Health Insurance Fund. We all know the challenges that are being currently experienced by the NHIF, and the question has been, is it a cash issue or is it a management issue at the NHIF? Will increased contributions to the NHIF ensure that NHIF is able to meet its obligations as they fall to employees? Need to see proper and prudent management of the funds that are being taken up by the NHIF. So there is a proposal to increase the rates of contributions to 2.75% of the gross salary for salaried individuals to the National Health Insurance Fund. I think this will have a very huge effect on the take-home salaries by employees. You can see so many changes are affecting what we call the take-home salaries or the net salary of employees. So, in a nutshell, those are the changes that the CS has proposed, maybe to push on some of them to push on the informal sector and bring financial inclusion into the informal and the small and micro enterprises. But there are also some punitive proposals that will have a huge effect on the common minority and especially the salaried or the employed person. So those are the main changes that have been proposed by either the CS, the finance bill, or the Committee for Finance and National Planning of the National Assembly. So I'll stop at that and hand over to Mike for the next session.
Okay, thank you, Kevin. Thank you very, very much. I'm sure you agree with me that panelists have done a stunning job in terms of trying to break it down. As you said, the finance bill this year is one of the biggest, and they have been able to manage that in under 2 hours. So thank you very much to the three panelists. So I will take a few questions. We perhaps may not be able to respond to each and every of your questions. There are very many of them. But I'm sure if your question is not answered here, you can always reach out to us and we'll respond specifically to you. So the first few questions to you are best. And the question is, do you feel the fuel purchase agreements will have a significant continued impact on the foreign currency rates?
I think that's a very good question, and I think it's more of a PR statement from the government, because when you analyze, I think we're trying to get credit for 6 months. I think in the interim period, I think there will be less demand for dollars. But I think after 6 months or in time to come, you still have to buy the foreign currency. So I do not actually think that it will have an impact on the foreign exchange, to be honest. But I think it's just more of a PR statement.
Right, and to you again, our question is, yesterday when the CS made his speech, it was clear that he is going, or he intends to change the debt ceiling calculation basis to more of a different methodology, which is going to be a debt anchor based on the GDP ratio. What do you think about that?
I think it's a good measurement, like what the US is doing, because US is now just $2 trillion there, they're sitting at that. But for us, I think it all depends on how the economy is going to grow and how the government is actually going to collect the revenue and how we're going to manage our expenses. It's very easy to say that we want to have our debt ratio about 55% of GDP. But considering the tax proposals, the global economic challenges, I think we have a lot of other factors to look into. And if we do not grow our economy, if we do not manage our expenses, and that will have an impact on the revenue collection, then it's very unlikely that we will get to the target that we want to. But I think it's important to acknowledge that the government does not want to increase the debt for the reasons that I mentioned earlier. But I think time will tell. Yeah, time will tell, and if they can manage the expenses, they can grow the economy. We're hoping that things in the US and in the UK, Europe, where inflation will come down, those economies will pick up. But it will take time. It will take time. I think it will be another 4 to 5 years before we hit that target. But I think in the interim period, we need to acknowledge that it's a good measure for us to give confidence to the investors that we're actually looking at that critically. I think it's also important that the cabinet secretary emphasized that come what may, we are going to ensure that is paid. That is reassuring investors. Don't worry, please do invest. We have been some kind of a bridging finance. The time to come, all will be okay. So it's going to be a challenge.
Okay, thank you very much, Professor, for that. And this is yours, Kevin, and it is about the interest restriction based on EBITDA. And the question is whether all local loans, even those that are not from the banks, are now being excluded from this formula.
Thank you, Michael. That has been a concern of many, that will it cover only local loans from banks or financial or any other financial institution. But if you look at how the bill is worded, the implication is that all loans, either from financial institutions or from any resident persons, will not be subject to the interest restriction provision. So the portion that will be subject to the interest restriction provisions will be any loans by an unresident person, whether related or not, and whether a financial institution or an individual or a company.
Thank you, Kevin. James, this is yours. And this is a very interesting question. I like it. And someone is asking, in case you have an accident, or you are sick, or you have an injury if you are an employee and you are compensated, is that compensation subject to VAT?
Thank you, Michael. As per the proposal, the answer is yes. And which is a concern because insurance compensations basically supposed to reinstate you to your original position at loss. So to us, we feel this is just a proposal merely supposed to generate whatever deficit that they have. But then also, if you look at that in tandem with basically the VAT exemption generally on financial and insurance services, you can actually see there's a problem. Because why exempt from VAT insurance, the insurance premiums that you pay, but then when it comes to you being paid the claim, then there is a 16% that's being applied on that. So I think this one is purely a misinformed proposal, purely aimed at collection of VAT.
Yeah, perhaps if I could weigh into that, James, and maybe to the participants, is that sometimes when the finance bill is tabled in Parliament, the drafting could be vague. Sometimes there is what in law you call lacunas or gaps. But sometimes we also look at what is the intention. Even if the wording is not very specific, and I think in this particular case, there is a possibility that the intention is to only levy VAT on insurance claims whose insurable interest were in the first place valuable. So things like medical claims, compensation for injuries. In my view, there is a possibility that the intention of that bill is not to subject them to VAT. But then again, this will become clear as the Finance Act is being signed into law. And definitely, I'm sure if the intention is otherwise, then there will obviously be implications because it will be giving on one hand and taking on the other hand, especially things on attacking the medical claims or compensation for injuries. Kevin, would you like to elaborate a little more about the recent and again, KRA is very interesting. They are the big boys in the industry. 2 weeks to file in returns or 3 weeks to file in returns. They have come and amended the return. And Kevin, I would like you to perhaps explain a little more on the disclosures that are required to be made and whether taxpayers have sufficient time to comply with that new requirement. And for taxpayers who already have filed the returns by the time the KRA made the announcement, what is going to happen?
Okay, thank you, Michael. Maybe just to mention is that the amendment of the return was done sometime earlier in the year. What came in late was the public notice notifying the public that this has already been included. And what are we talking about being included? If you can recall, through the Finance Act 2021 and through also the Finance Act 2022, there was an introduction of what we call country by country reporting requirements for multinational enterprises. Now, these country by country reporting requirements require that entities that are part of a multinational enterprise group are supposed to abide with 3 conditions if the ultimate group entity exceeds a turnover of 95 billion shillings. The first condition was that they need to do a notification within the year or before the last day of the year, notifying the commissioner of the information about the group in terms of location and so forth. The second requirement was that by the 30th day of the 6th month after year end, you're supposed to file a master file and a local file with the Kenya Revenue Authority. The third one was within 12 months after year end, you file what we call a country by country report. There is also some refinement to this where the entities that will be required to file the country by country report will be those entities where the ultimate valid entity does not have an obligation to file. Now, what we have seen is an attempt to bring all this together into the income tax return for companies. In that, now, when you disclose that you have related, remember in the first section of the basic information, so it asks you, do you have any related non-resident entities? When you click yes, it activates that tab. And in that tab, you're supposed to give the details of the transactions carried out with the related non-resident persons, the contents of those transactions, the transfer pricing method that has been applied, which in effect implies that by the time of filing the return, you want to have in place a transfer pricing policy documenting the transfer pricing method that has been applied. You are also supposed to include details of where those related entities are located and the amounts of related balances that you have with those related entities. Remember, based on the income tax return, there is no threshold of the amounts that you are supposed to disclose. So maybe this is an attempt by the Kenya Revenue Authority to ensure that all persons that have any related party transactions with non-resident related entities are brought under the ambit of transfer pricing scrutiny, and those entities have in place a transfer pricing policy document at the time of filing the return. In terms of timing, I would say this is very deliberate at such a time when the KRA is increasing focus on related party transactions to shave up tax collections.
Thank you, Kevin. To you, James. There is a proposal that any invoice that is not generated through the new e-kits will no longer be around for tax deduction. And the question is, what will you do with invoices or receipts that are issued by farmers who are not vatable and are not required to be VAT registered, or any other supplier for that matter who is exempt? What do you do with those invoices?
Honest answer, Michael, I don't know. And it's what I alluded to earlier. Number one is the practicality of how the e-teams will be rolled out for all business types, whether formal or informal, whether VAT registered or not. And when we made our submissions to the Finance and Planning Committee, we really asked that question because even as we speak, e-teams is under pilot. Not each and every taxpayer has been onboarded, including the big players. So how is this supposed to work for the very small businesses, and especially those in the informal sector, or those who have very low turnovers? And our recommendation basically was number one, sort of a phased application of these requirements, and maybe a consideration also of the threshold of expenses that would require an ETIMS compliant invoice. Because, and that's why my immediate answer was, I don't know, because how is this going to be practically applied? So there's that real challenge. But as the proposal is, it basically means it becomes law. And there is insistence, then it means should you then selectively choose to deal with particular suppliers, or what really are they telling us? Obviously, we know that ultimately they want to ensure compliance, but they also need to be practical and reasonable when it comes to implementing this proposal.
Thank you, James. And there's a very good question that has come from one man called James David Kabebeli, who is our retired partner. And I don't know why he has chosen to ask a very difficult question. He said Article 2:1 of the Constitution provides that the burden of taxation shall be shared fairly. The key one here is fairly. And he is asking, is the housing levy not an unfair burden on employees given that self-employed persons also earn some income? Thank you, David, for the difficult question, but I know you knew I would answer it, so I will take it myself. Just to give you a perspective, there are just about 5.8 million registered taxpayers in Kenya. Now, out of the 5.8 million, a lot of them are corporates. So individual taxpayers in the system could as well be below 3 million. We have a population of close to 50 million people, and of course, many companies that are registered, whether those companies are resident or non-resident. So approximately, you could easily say we are close to 60 million persons, whether natural persons or corporates. Now, out of the 5.8 to 6 million registered PINs, the active taxpayers are actually less than 3 million shillings, 3 million taxpayers. Now, of course, 3 million taxpayers, a majority of them are actually employees, whether in government or the private sector. And indeed, this is what we have said all the time, that the burden is on the shoulders of very few people. I think it's actually a very lazy way of government, a very lazy way of thinking by government, to think that the housing levy should be borne by only people who are employed. These are people who cannot escape taxes anyway because we pay on a monthly basis. And there's a big population of what I don't like calling it the informal sector because it's not really informal. It is a sector that generates a lot more wealth than the employed people. And these people are not being subjected to the housing levy. We will be told that they are hustlers. But I will tell you, a lot of these people in the informal sector earn a lot more than people who are employed. Government-owned statistics show that there are very few people who earn more than 100,000 shillings. But I can tell you, there are very many people in the informal sector who earn over 1 million shillings every month, and they are not shouldering their rightful burden. So, David, I hope I attempted to answer you. I agree through with you, and I know you have a house somewhere. You probably don't need to be paying this levy. But the government is also saying that we have to support the people who are not able to put up structure for themselves. James alluded initially to the fact that it may not necessarily be that many Kenyans have a problem with the housing levy. It may be that people don't trust these funds. People are very little trust for what happened when the NSSF used to do the housing. You remember those days, what happened? Very recently, NHIF has not been able to meet its obligations, and all these scandals anyway are associated with these kind of funds. And number two, David, also to bring to your attention the fact that yesterday I listened to the chairman of the budget committee, Didi Nyoro, in the evening after budget, arguing that it doesn't matter that the regulations of how to manage this fund are not in place, the money can be parked somewhere. I don't know whether it's in a box or in a safe or in central bank or where, but I think these are the questions Kenyans are asking, and Kenyans deserve answers. So James, David, I think I've attempted to answer you and many others who have a question on the same. And now, because we have to bring this to a close, I want to be fair to the panelists. And I want the panelists to wear the shoes of the cabinet secretary of the president of this country, who requires money to run the economy. I want each one of them in a minute to tell us, or less than a minute, what it is that you would have done different if you are a good old professor in terms of making sure government have money to continue running. And I start with you, Ken.
Thank you, Michael. I think if I were in those shoes, the conversation has been, if you put yourself in a hole, what do you do? Do you continue digging, or do you find ways to get out of that hole? I think we are in a hole as a country, and the CS ought to have devised ways to ensure that the economy gets out of that hole. How these have been taken? Maybe first and foremost would have been to find a solution where, instead of even increasing our budget to 3.6 trillion, can we target our budget to priority areas and reduce it to such a manageable level where we are able to finance more than 80 or 90% of it through tax collection, and the remaining bits that needs to be borrowed, we to ensure that our borrowing are kept at a lower level than we have had in the previous years. Maybe the second thing would have been to ensure that we expand the tax base. There has been a conversation about lowering the tax rate may have an impact of increased tax collections. Maybe it's something that needs to be looked at, especially on the monthly rental income tax, with a proposed reduction of from 10% to 7.5%. If I was a CS treasury, maybe I would have looked at other sectors of the economy where if there is an impact of increased collection through lowering the tax rate. I think, Michael, those would have been my immediate reactions or measures to ensure that the government remains afloat.
Do you have a question?
Thank you, Mike. I think it's a very difficult question to answer because you have to balance the receipts and the expenditure. And it's no doubt in my head that this is an IMF World Bank driven finance bill. I think I would have only looked at the expenditure side of things and deferred some projects priority. I think this is not the time to raise taxes, bring levies. This is the time to increase the disposable income of our energy. It's time to increase the tax base. As you rightly said, we only about less than 6 million taxpayers. 6 million taxpayers cannot support a country with a population of more than 50 million people. I think this is an area that we need to particularly look at. We appreciate and understand that there are global factors, and the factors where that is an issue, especially with the depreciating currency or that is deteriorating. But I think I would have deferred a lot of these taxes and say, you know what, we will look at it next year and see how things go.
Yeah, thank you, Michael. I would choose to look at it this way. If you look at the 3.68 trillion budget, 1.6 trillion is already our debt obligations. So that's the starting point. And the risk the country would run when it comes to defaults would even be more severe. Then there is the issue of development expenditure. I think Alpesha alluded to that. Number one, are we looking at projects that are white elephants? Are we looking at a possibility of scaling down on the development expenditure? That's the first issue to reason the spending. Recurrent expenditure is recurrent expenditure. Obviously, touching or trying to reduce recurrent expenditure, then it still takes us back to the discussion of reduction of current expenditure. Then there has to be layoffs by government. Still piles up to the problem. But then I think what normally happens is a very hasty budget making process with a very myopic view. And now this speaks to the part that Michael have articulated, that we have very low compliance levels. We have very low tax registrations and active tax declarations and payments, and that for me should be the priority. The automation for customs, I think, through ICMS, whatever we are discussing about teams is sort of geared towards ensuring compliance and whether in the tax base. I believe there are more efforts that can be done, and I will still keep repeating. There was a proposal some years back to sort of look at it from a single business license perspective. The county governments have the repository of all registered business, including what Michael chooses not to consider to be informal sector, because for you to do a business, you must have a license. This will be brought up with the Finance and Planning Committee and the whole politics around the never-ending disputes between county governments and the national government on the allocations to the counties, and the fact that KRA will be the primary agency that will collect any such taxes for the counties for the whole country became an issue. But then we asked, this is one and the same government. KRA is one and the same. The county government is actually part of Kenya. And obviously, in the interest of alleviating the challenges that they always face in terms of deficits, why can't they work something out? And I think Kevin was there, and the chairman says they will think about it. So I think there are solutions, but in terms of wasted, government wasted, I think that is a key thing. Money is being spent on issues that are not necessary. And if you go by the sentiments of Kenyans, and you can go to Twitter and any other social media platform, I think Kenyans have expressed what they feel about the budget and also the promises that were made during the campaigns. And that is reflective of the actual situation on the ground. So I believe there are solutions like each of the panelists have mentioned, and it's really up to government to work this game.
Thank you very much, James. Before I pass a vote of thanks to the various people, I have one announcement today. You have the chance to see us on the screen, but we have not been able to see you for many years since COVID came. You may recall that these budget events used to be in physical attendance, and I want to now announce that the partners of PKF have missed you, and together with our staff. And around 7th of July, we wish to extend the invite to all of you, to be communicated. We will be holding a physical function that will discuss the Finance Act. We expect that the Finance Act will be signed into law as required. It's mandatory that the president has to sign it by the 30th of June. And therefore, on the 7th, which is on a Friday, we will be having an event where also we'll have a chance to see you, because right now I can't see you on the screen. Having said so, for those who are members of ISPAC or ACCA, you are going to receive, if you have registered and given us your email, you will receive a certificate, and that certificate for attending this function or this webinar entitles you to some CPD points. You can either claim with ISPAC or with ACCA. Having said so, I wish to thank a few people who have made this happen. First of all, I'll start with the three panelists here. I know they slept very late to prepare for this. I want to thank you for your insights. I want to thank the entire teams in PKF who made it possible to prepare this overnight and to be able to deliver this event this morning. The technical teams, the IT team, Brian and your team, you've done a very good job to set up this studio for us to be able to deliver this fantastic event. And if there's anybody that I have forgotten, please feel that we appreciate the role that you played in this. And very finally, there is one guy that we forget always, and that is the MC. I also want to thank myself for performing very well in that show. Thank you very much. We wish you a good day and a nice weekend ahead. So thank you very much.